Hi there, my name is Johanna Boven-MacLean. I'm a senior insolvency advisor with BDO Debt Solutions. Thank you so much for having me on another episode of Wisdom Wednesdays. Today we're going to talk a little bit about finances. Who is BDO? BDO Debt Solutions is one of Canada's oldest and largest debt help firms, helping Canadians find the right solutions to their debt problems since 1958. In offices across the country, BDO's local teams of debt professionals include licensed insolvency trustees, proposal administrators, and credit counselors who provide consumer proposals, personal bankruptcy, and credit counseling. When was the last time you thought about your financial wellness? How well do you know how to budget? How prepared are you for retirement? Do you plan for the unexpected? Many Canadians face challenges these days with personal finances and are lacking the confidence, skills, and knowledge to change their circumstances. Our focus is on enhancing your skills so that you can meet your financial goals. What we're going to talk about today is some financial wellness, savings and budgeting, credit and borrowing, fraud awareness, credit bureaus, ratings, and scores. Financial wellness can be defined as a personal assessment of one's finances and what they perceive they can or cannot afford in their day to day lives based on one of the following criteria or more: amount of savings in the bank, amount of monthly disposable income, amount of credit card debt outstanding, ability to take an annual holiday, ability to save to make a large purchase, can comfortably respond to a financial emergency. Conversely, financial stress can be defined as the unpleasant feeling that one is unable to meet financial demands, afford the necessities of life, and have sufficient funds to make ends meet. Savings and budgeting. Saving money is easier said than done. With a balanced budget and SMART goals in mind, it becomes much easier if you create a habit and you stick to it. Now, what is a budget? A budget is the first step in organizing your money. It's actually the personal plan that tracks your spending to help you make sound spending decisions. It's a working document to be updated and reviewed regularly, listing all of your needs and wants. A budget should include your SMART goals, which are specific, measurable, achievable, realistic, and timely. A budget also includes income, money coming into your household, such as earnings, child tax benefits, support payment, pensions, then expenses, everything you pay during the month. Then there's debt payments if you have them, loans, lines of credit, credit cards, payday loans, and cash advances. Also, you can incorporate savings such as an emergency fund, tax-free savings account, even RRSPs or RESPs for children education savings. Budgeting is setting goals. We believe that you should pay yourself first. Short-term goals would be things like dinner out. Maybe you need a new pair of shoes or some new clothing, a music or game download. Medium could be we need an appliance soon. It could be a trip, 3 to 6 months of living expenses saved as an emergency fund, or eliminate debt if that is what the issue is. Long term, children's education could be with the RESPs, retirement, pension, RRSPs, paying off debt. Tips to meet your financial goals: calculate the amount needed. And how many months do you need to save? Can you set aside the amount needed every month? Trim expenses or increase your income. Needs and wants. Track your expenses for a 3 month period. Save receipts and use bank statements. For many people, it's easier to use a bank statement because we use our debit cards for most of our purchases, including groceries and gas. Calculate the amount you need to meet expenses each month, but remove non essential expenses. Create a plan, write it down, put it into action. Measure your actual expenses versus your budget. Then monitor your spending and adjust to meet the budget. Tips for easy budgeting: envelopes and jars. Yes, this sometimes still exists. Think about how much money you need for groceries, fuel, maybe dining out, or if you're a coffee lover every morning, personal items for a week or a month, and put each amount in a separate jar or an envelope. Once the jar is empty, you've reached your spending limit. There's the paycheck planner. You record all your bill payments and debt payments. It could be credit cards, it could be vehicle loans, even your mortgage, and line them up with your pay periods. 3, record all income. Write down the amount of household income received each month, including your pay, support, benefits, credits from CRA, all sources of income. Then track your spending, your expenses. Save your receipts to record everything that you and your family buy. For items like transit tickets, coffee, or snacks where you don't have receipts, mark down the amount in a notepad or use your mobile device. At the end of each week, record all amounts in each spending category. And at the end of the month, add up all the expenses and it's subtracted from your monthly income. Again, writing things down might not be easy for people, so some people rely on their bank statements for that. Areas to save. This is something that we talk to a lot of our clients about. Check your bills. Look for errors and overcharges. Avoid late fees, penalties, and interest if possible. Negotiate your plans. Look for current deals on bank services, phone, internet, subscription services. Bill bundling TV, internet, and phone. Avoid service charges and ATM fees if possible. Review your food costs. This is a big one, it seems. Eat at home and bring your lunch versus takeout. Meal prep and cook one dish for several meals. Look for discounts and coupons at multiple stores. Buy in bulk versus don't buy in bulk. Then consider the costs of owning versus renting. Look at your car, home, or anything you may consider financing. Could be furniture, renovations, new technology. Calculate the real cost of owning: gas, insurance, maintenance, property taxes, things like that, and understand the cost of financing versus leasing. Credit and borrowing. Using any form of credit is really borrowing money. Consider the cost of credit. Credit is access to someone else's money. Loan interest rates may be fixed or variable. Fixed are things like bank loans, your mortgage, could also be like your vehicle payment, which the rate remains the same for the period covered by that loan and does not change. Variable. Variable could be a mortgage as well as like a line of credit or even a credit card. Rate is usually tied to an indicator such as the bank's prime interest rate. The loan states how often, when, and by how much the rate may change. Lower rates mean the principal loan balance is paid off sooner. Higher rates mean the principal loan is paid more slowly since more of your monthly cost goes towards the interest first. Interest rates fluctuate over time depending on economic conditions. We've seen a lot of this lately. If interest rates rise, your borrowing or credit costs could go up, which may affect your ability to repay your debts. Credit card quiz. You're paying a credit card bill just a couple of days after the due date will not affect your credit. True or false? True. It will not unless you're 30 days behind. Last month, your credit card balance was zero. This month, your statement shows that you made a $500 purchase. If you pay off $400 by the due date, you will be charged interest only on the $100 left to pay following the next month. True or false? That is true. You only pay interest on what the balance is remaining. If you use your credit card to take money as a cash advance, you do not have to pay interest on the amount you have withdrawn if you pay your credit card bill in full by the due date on your statement. That is false. Paying off your credit card monthly is always the best option. If that's not possible, you can still reduce the amount of interest you are paying by making more than the minimum monthly payments. Sometimes, by making the monthly payment biweekly, you can cut down on the amount of interest. But let's look at some comparison of credit card repayment options, assuming the following details. Your credit card balance is $5,000 with an annual interest rate of 19.99%. Option A, make only the minimum payments, The time to repay that is 20 years and 11 months, and you've paid almost $6,000 in interest. Option B, make the minimum monthly payments, but add maybe $50. Time to repay, 5 years and 3 months. Interest paid, $2,300. Option C, make the minimum monthly payments plus $150. Time to repay would be 2 years and 4 months with only $1,100 in interest. So as you can see, by accelerating your payments or changing the way you make your minimum payments can save you a lot in interest in the long run. Things to remember about credit. Using a credit card is borrowing money. It is not an extension of your income. Use other sources of credit with lower interest rates, maybe like a line of credit versus a high interest credit card. Pay the balance off in full every single month. Pay more than the minimum, which helps reduce your principal. Do not miss a payment. Do not treat as found money. Try not to increase limit unless you're very disciplined. Read and review your monthly statement. Take a look at sometimes the insurance charges. Is that insurance for you? Can you qualify for that or not? And if you are paying insurance, quite frankly, you can easily basically cancel the insurance, which also helps reduce the interest. Do not take cash advances because interest starts immediately as soon as you do that. Secondary card holders, primary card holders responsible for the entire debt. Never lend your card or give your card to somebody else. The cost of credit. Do your research. What interest rate and fees the lender charges depends on many factors. Cost of money, the risk involved, internal bank policy. The bank also considers credit score, debt to income ratio, net worth, asset base, type of employment, age, purpose of loan. Interest rate for unsecured credit tends to be higher than the interest rate for secured loans. Understand the true cost of your loan. Add the interest charges when calculating the costs. So a $15,000 loan for 5 years at 7% interest, total paid is $17,820. The same $15,000 loan for 5 years at 15% interest, the total paid is now $21,400. The same $15,000 loan for 5 years at almost 30%, the total paid is $29,000. Co-signers and guarantors. This is a very popular question when we're dealing with our clients. A loan guarantor, because I'd like to go over some of the differences. Loan guarantor guarantees payment of the full balance in the event the primary borrower defaults. Banks may request a guarantor if there are risks associated with the lending. Common with business loans where director secures payment personally, can be limited or up to the full loan value. Cosigner or joint borrower agrees to the terms and conditions of the loan and is jointly responsible for payment and 100% of the actual loan amount. Cosigner is just responsible for the loan as the original borrower is. Supplementary card holders. It does depend on the term of the contract. Primary card holder solely responsible for all charges and debts, or both the primary and supplementary card holder are jointly responsible for charges and debts. Primary card holder responsible for all charges and debts, while the supplementary card holder is responsible only for the charges on that supplementary card. Fraud awareness. This is getting a little bit more and more serious as we see a lot of the scams that are going on out there right now. Red flags of fraud and scams. Remember these golden rules to help you beat the scammers. Number 1, always get independent advice if an offer involves money, personal information, time, or commitment. 2, there are no guaranteed get-rich-quick schemes. Sometimes the only people who make money are the scammers. Number 3, do not agree to offers or details right away. If you think you spotted a great opportunity, insist on getting independent advice before deciding. 4, do not hand over money or personal information, including your date of birth, banking information, your social insurance number, or sign anything until you've done your homework and check the credentials of the company that you're dealing with. Fraud awareness tips. Do not rely on glowing testimonials alone. Find solid evidence of a company's success. Go directly to a website you're interested in rather than clicking on the links provided in an email. Never spend money or give credit card or online account details to anyone you do not know or trust. If you spot a scam or have been scammed, there are government agencies you can contact for advice or to make a report. There's the Canadian Anti-Fraud Centre, the Competition Bureau's Information Center, and sometimes the RCMP can get involved. Now, let's move over to credit reports and credit scores and credit ratings. This is also a very popular topic. This is something that we didn't learn in school, but it definitely is something that we need to learn. A credit report should be checked at least 1 year for mistakes. The request is free when it's sent in by mail or online, can be a fee. To protect yourself from someone stealing your information, check your suspicious activity, your credit worthiness. Credit bureau agencies in Canada are Equifax, which is www.equifax.com. There's also a free site called borrowwell.com, which gets its information from Equifax. There's TransUnion, which is transunion.ca. Credit Karma, which seems to be a very popular site, is a free site to make a free profile, which is hooked up to TransUnion. A copy of what a credit report request looks like is included on this. 5 types of information included in credit reports. Identifying information. So your name, spouse's name, date of birth, social insurance number, driver's license number, address, and telephone number. Employment information. Your current and previous employers and job title. Credit information. Account balances and credit limits, whether you have paid bills on time or whether you have unpaid bills that were referred to a collection agency. Public record, things like bankruptcies, liens, or civil actions. Inquiries by creditors, lenders, insurers, and landlord. You can correct any errors or omissions on your credit bureau file. Corrections are made directly to the bureaus, are not through your bank or your lender. Credit report versus credit rating versus credit score. Let's do credit report. Credit report is the main tool lenders use to decide whether to give you credit. It includes your credit score and credit rating. Updated regularly by the companies that lend you money, such as credit card companies, banks, finance companies, credit unions, and retailers. Then lenders consider the information as fact, such as employment, borrowing history, defaults, etc. Credit rating. Each time you receive credit, the lender will rate your payment record on a scale from 1 to 9. R1 means you pay your bills within 30 days of the due date. R9 means bad debt collection or bankruptcy. Finally, credit score. Credit worthiness is based on several different criteria. 1, payment history. Then there's outstanding credit balances, the debt level, types of credit, meaning credit cards, lines of credit versus loans, number of inquiries. Account status is expressed as open, closed, inactive, or paid off. The Financial Consumer Agency of Canada has a publication about understanding your credit score, and you can find them online. Primary causes of financial stress. Increased cost of living, which a lot of us are seeing right now. Life events such as job loss, relationship breakdown, accidents, and illness. Psychological factors, things like alcohol, drugs, and gambling. Income stagnation, and lack of financial knowledge. Warning signs of debt affecting your health. Worried, stressed, or irritable. Marital problems, and addictions. Warning signs you could be carrying too much debt by only making minimum monthly payments, using credit for basic needs or living expenses, using one form of credit to pay another. We call that robbing Peter to pay Paul. Falling behind on payments. Collection companies are calling. Using payday loan companies as the quick fix. Employer payroll advances. High-risk lenders. Using home equity line of credit as cash. Spending 20% or more of your income on debt. According to Health Canada, long-term financial worries cause stress. Stress is considered to be a risk factor in many diseases such as heart disease, some types of bowel disease, cold sores, and mental illness. Canadians right now are struggling financially. I think we have all are seeing this. 40% of working Canadians feel overwhelmed by debt. That's up from 35% from last year. 46 of Canadians would experience difficulty if their monthly debt payments went up by 200. More than one third of respondents say their debt load increased over the year and say it will take more than 10 years to pay down the debt. With household debt in Canada having hit a record high of $1.69 for every dollar earned, the rise in interest rate will pose serious risks to many families. A poll conducted in 2024 reported that 38% of respondents say any further increase in interest rates could move them towards a bankruptcy. Employers take note. 46% of employees say financial stress is impacting their workplace performance. And let's talk a little bit about debt relief options. Debt consolidation loan. That's usually with your financial institution. Usually a lower interest rate than your current unsecured debts combined, plus a fee equal to 10% of the debt level. Must qualify or have a cosigner. May require you to refinance your home. And if you use your car or home as collateral, there could also be risks involved. Debt management programs with credit counseling. Debt management program, which is an informal proposal where you need to pay back 100% of your debts plus a fee of 10% on your debt level. Voluntary agreement with your creditors that offers no court protection, and fees are not regulated and can vary widely. Consumer proposal. Only a licensed insolvency trustee can file a consumer proposal. You only have to repay back a proportion of your debt. Stops collection calls, wage assignments, and all legal action. Allows you to keep your assets. One equal monthly payment. Includes 2 credit counseling sessions and only requires a majority of creditors to accept and is binding on all creditors. Bankruptcy, often seen as the last result. A licensed insolvency trustee will explain all your options if bankruptcy is right for you. It releases you from most, if not all, of your debts. Stops wage garnishments, harassing phone calls, and legal action from your creditors. Also includes 2 credit counseling sessions. And you will not lose everything if you file for bankruptcy. That is a common myth. Beware of offers that sound too good to be true. Debt consultants are not licensed to file consumer proposals or bankruptcy under the Bankruptcy and Insolvency Act. Fees of debt consultants vary and are not subject to a regulation. Debt consolidation loans. Pay off your debt and make one easy monthly payment. Ontario debt relief. See if you qualify for relief. Pay off your debt and make easy fixed payments. Cut credit card debt by 65%. A-rated by the BBB. Owe $20,000 in credit card debt? Consolidate now. Get a free quote. It's time for a better short-term loan, which is minus 548% for a payday loan, 48% for another loan with a different company. And need fast cash? Pre-approval in 3 minutes. Credit card debt program eliminates over 80% of debt. So just be aware of the company that you're going to be dealing with these things. Again, thank you so much to the Kingston Chamber of Commerce for having me talk to you today about Wisdom Wednesdays. I hope you all a well financial future.